Assalamu alaikum. This is lecture number 22 of Advanced Cost and Management Accounting. We are discussing the topic of budgeting. Budgeting, as we have said, is a plan for future activity. It is looking ahead and trying to estimate and trying to forecast the activities that are likely to occur in the period which we are budgeting for. There are various ways, we said, of formulating the budget, various different techniques. We have talked about the activity-based budgeting. We have talked about an incremental-based budgeting. When we talk of budgets and we say that this is a plan for the future, a question might arise that if we make a plan for the future, then do you expect that the events in future will be according to plan? Well, of course not. It is obviously not possible to completely and accurately predict future events. And it is not possible to look into the future and say with any certainty that this is what is bound to happen. So what is the role of budgets? And why are we making these plans? These plans and budgets are essentially, they are trying to focus our attention, create some targets. They are trying to give us an estimate of the resources in the business that are going to be needed and to arrange for those resources in time and ahead of need. In actual fact, events will then reveal actually whether the budgets are met or not, but these are targets and these are to direct efforts of the organization and a means of controlling actual performance and comparing against a target and trying to rectify and correct events and activities as the business goes along. We are today going to talk of zero-based budgeting. So we said activity-based budgeting is a process where the future plan is going to be based upon what activities can be foreseen and forecast. The traditional and normal way, common and easily used way of budgeting has been to use incremental budgeting. The incremental budgeting implies that we use last year's figures as the base and we make some kind of an addition for what we think the additions might be over the next period. And that becomes a budget for the next period. We have talked about the deficiencies and the problems and disadvantages of using this approach, but nevertheless, we must remember that this is the easiest approach and this is still followed by a large number of companies because of the ease with which it can be done. Nevertheless, we must bear in mind what are better ways, what are more beneficial ways of going through the budget process and arriving at a budget which is going to be more useful. Zero-based budgeting is something that regards the future as starting from zero. In other words, disregard the past. What happened last year is not to be examined for next year's budgeting. It is as though all the activities are going to occur for the first time. So all the plans are going to be based on activities, productions, all the business-related activities as if they are happening for the first time without regard to what happened in the past. The advantage, we will look at these advantages and benefits later on, but the basic advantage is that you are not looking at the past and allowing the past inefficiencies and wastages to run through the budget process, become part of this year's budget and then be allowed and to continue and occur in the future periods. So this is basically the idea that zero-based budgeting is implying that we start from zero, we take account of all the activities as if they haven't happened before, and we are going to project and build a budget on that technique. Zero-based budgeting, also known as priority-based budgeting, emerged to overcome the limitations of incremental budgets. So we have said that this has emerged to overcome the limitations of incremental budgeting. Incremental budgeting is taking the last year's actual figures, seeing what happened last year, and making an adjustment or an allowance to add for additional costs. This is just incremental, and this is just basing on whatever happened last year. Last year's budget might have been subject to various inaccuracies. Now we are going to look at, in incremental budgeting, last year's performance. Usually you look at last year's actual performance. Now in actual performance, many times wastages will be built in, many times inefficiencies will be built in, many times several things will happen in the future period which did not occur in the previous period. So in order to overcome these kind of limitations, the zero-based budgeting concept came about. This approach requires that all activities are justified and prioritized before a decision is taken to allocate the resources. So here we are going to look at all the activities and prioritize them in a way that we should have some idea which is preferred, which would be done first, and which are most essential, and therefore resources have to be allocated accordingly. So the prior period activities and decisions are going to be reviewed, and they are now going to be set in some kind of an order, and resources will now be allocated on the basis of the present thinking. Zero-based budgeting also focuses on programs and activities instead of line items of traditional budgeting. By line items, we mean there is our budget, let's say, of the profit and loss account or the cash flow, and every single line within the profit and loss account, starting from sales, and then the cost of sales and expenses, admin expenses, marketing expenses, and so forth. Each of these are line items. Now, instead of just looking at the line items and saying, well, last year administration cost X amount, so this year perhaps it will cost 10% more. Instead, we are now under zero-based budgeting going to focus on the activities and the programs that we are likely to carry out. And therefore, the decisions that are required for these programs and the resources that are required for these programs will be assembled and allocated. Zero-based budgeting also focuses on programs and activities instead of line items of traditional budgeting. Zero-based budgeting works on the premise that each year's budget should be compiled as if the programs were being launched for the first time. That's what we have said, therefore, that these decisions will be based as if these activities are going to be launched for the first time. In other words, we will not look at the past activities, we will not look at the history, and we will not look at last year's figures in arriving at a budget for the next year. All funds are allocated on the basis of cost-benefit or similar analysis, in questioning long-standing assumptions, and serves as a tool for systematically examining any unproductive projects. The allocation of funds is going to be on the basis of need. The allocation of funds is going to be after doing some kind of analysis. So an analysis of what is required, some thought, some process, and this will require managers to look ahead and to try to forecast and foresee the difficulties and problems that might arise, and therefore to provide for them before the start of the period. The problems might be the kind of equipment they have, the machinery they have, whether the machinery is sufficient for the capacity being planned, for the output and production being planned, whether the machines are going to be in order, if a certain amount of maintenance is required or replacements are required. So these are factors that can be and should be thought of at the beginning of the period so that there is a smooth operation and smooth running of the business. It is best suited for discretionary costs such as advertising, research and development, and training. So by looking at each activity in a separate and new way, we are trying to eliminate any unproductive costs that have been built into the actual figures of the business. So we will try to eliminate those unproductive costs, and we are saying that the best area where this can be applied is things like research and development. So examine and pretend as if there was no research and development, and all of that has to be done now from the start. Training is another easy area where you can see what training is needed. The training programs that are required for the next budget period, usually 1 year, can be estimated at the start of the period. Each category of employee identifies their training need, which has to, of course, be approved by the supervisor. And that training can be scheduled and have a complete plan for the year for all the trainings that need to be occurred, and then their costs identified and the cost included in the plan. This, we are saying now, therefore, is easy for zero-based budgeting, where we want to start right from the beginning and not look at what happened in the previous years and not look at their past performances. We have called these as discretionary costs. So it's much easier in discretionary cost. What is a discretionary cost? This means the company has a lot of flexibility in deciding how much of cost should be incurred. It is dissimilar to, let's say, production cost, or let's say energy cost. Production costs, where materials are being used, the cost of materials are the usage, and cost is whatever is given and whatever production the company is intending to make, the output. Whereas in things like marketing and training, the organizations have the flexibility to decide how much of cost should be incurred. They have an ease of either increasing or reducing this cost. So that's why it is a discretionary cost. And so for such discretionary costs, it's much easier and much better to use our technique of zero-based budgeting. ZBB involves the following 3 stages: a description of each organizational activity, that's number 1, evaluation and ranking of decisions in order of priority, that's number 2, and thirdly, allocation of resources based on order of priority up to the spending cutoff level. Description, evaluation, and allocation. First of all, you need to describe the activities. Then you need to evaluate the order, the importance, and thirdly, the allocation of resources. And you can have a spending cutoff level. A spending cutoff level, this means that you can have a limit to the various activities and a limit to the amount of expenditure, amount of spending that is allocated to any particular expense. Therefore, we've talked about, first of all, a description. A description will be giving you details of the activity planned. If we looked at the research and development expenditure, there a description would be required of the different research activities that are planned. The products that need to be reviewed, the kind of new processes that are going to be examined, and what is perhaps the desired result and objectives of this research. So this description is going to be laid out and then evaluated. Evaluated means the importance seen, the cost seen, and see how it is going to impact the business. The research and the results of the research, if they are found that they are going to be beneficial and they are important and needed for processes and business in the near or immediate future, those are going to be prioritized and given greater importance. So resources are going to be allocated to research of that nature ahead of something which is more long-term, more general, and the benefits perhaps are not as clear to see. So description, evaluation, and then allocation. Allocation, for ease, you can have limits. That this kind of expenditure, for example, marketing is usually quite a high expense item on most companies' budgets. And so many people have different ways of setting some kind of a cutoff level and saying that we are going to spend this much. Sometimes it can be used as a percentage of sales, of estimated sales, or sometimes it can be based on activities and its cost. Benefits of zero-based budgeting. Benefits of zero-based budgeting over traditional methods are being claimed as follows. Zero-based avoids the deficiencies of incremental budgeting and represents a move towards the allocation of resources on need basis. The level of funding is not taken for granted. This, of course, is the major advantage and major benefit of zero-based, that it is looking at the resources of the organization and their usage on a need basis. Wherever they are needed and where the need has been prioritized according to preferences and need of the business, that's where the resources are going to be allocated. Incremental budgeting, which is usually used and easy for organizations to adopt, that has these disadvantages. So the deficiencies of the incremental budgeting, especially where the need basis is ignored, is what is highlighted under the zero-based budgeting. Zero-based takes a questioning attitude rather than one that assumes the current practices represent value for money. Expenses should not be taken for granted. It should not be assumed that if this year the expenditure in one area has been X amount, then in the next year it will be more. So this attitude of questioning the need and questioning the usefulness, this is what is promoted by the zero-based. We are going to question and we are going to examine and we are going to analyze and then have a sequence and ranking of the need of the resources. And that makes the zero-based more useful and more beneficial for the organization. Zero-based focuses attention on output in relation to value for money. So at all times, it is doing this analysis of value for money. What we are doing, is there a need for it? Will the company benefit from it? This is value for money. The resources are being used. What will the company get the benefit? And to try to compare, do the cost benefit and make sure that value for money is being achieved wherever money is being spent. This is therefore a much organized and a much more useful manner of consumption of resources, and there is a conscious effort by the organization to find value for money, try to find value for the resources, and give the organization the value for what resources are being consumed. Zero-based lack of success. The main reason for its lack of success would appear to be that it's too costly and time-consuming. Having defined the benefits of zero-based budgeting, one would imagine that many organizations would be using, and this would be a very successful method for companies to do their budgeting. In actual fact, surveys and different research has shown that a very small percentage of organizations actually use zero-based budgeting. And so we are now looking at some of the reasons for this lack of success. The major reason we have said for the lack of success is that it would cost a lot. Whereas companies are already spending quite a lot of time in this budget process, and I referred to nearly 6 to 8 month period earlier on, that's the kind of time the budget process in large multinational organizations can take. So this time spent of their senior management is an expense, and the cost has to be managed. So where we feel that this is a successful way and this is a beneficial way for organizations to go about their budgeting, they will have to look at the cost and the time it takes to every year. The managers sitting together and having to look at all the activities will take time. It might have benefits, but it will take time. So if it is done on a company-wide basis every year, then the cost will have to be considered as an important factor. And if it is going to take too long, and if it is going to take up a lot of cost, then it might be something that the companies will try to avoid. So we have said, therefore, that time consuming and the cost is one of the major reasons for lack of success and lack of popularity of this zero-based budgeting among organizations. The process of identifying decisions and determining their purpose, costs, and benefit is extremely time-consuming. Frequently, there is insufficient information available to evaluate and rank decisions. This is also an important aspect, that ranking decisions is also not an easy process. And ranking the priority of resources and which is the greater need for the organization can be a long process in which there can be some kind of dispute and there can be some disagreement within the organization. Each manager probably will regard that his area and his consumption of resources is important. And so an overall view will need to be taken. And as we have said, very often the exact and the detail of information required to make a very considered ranking decision is not available. So that makes this process harder also to adopt. Organizations tend to approximate the principles of zero-based budgeting rather than applying the full-scale approach. For example, applied to some areas of the organization selectively. So what happens in many occasions is that companies, when they find that it is too time-consuming to follow the entire process for the full-scale operations, but they also at the same time acknowledge the usefulness and the benefits of zero-based budgeting. So instead of using this entire process for the entire organization, and as we said, that might take a long time, they might use this process selectively. And we referred to discretionary expenses earlier on. So the organization might apply this selectively to certain costs. In other words, they might use the zero-based technique for research and development or for training or for marketing, but not for the entire production and the distribution and sales and the whole process. Therefore, this process is going to be used selectively because, as we said, the lack of success is because of the time it takes and the cost that would incur in case of having a full-scale adopting this process. Selectively, the organizations can have the benefit in areas where they find they are able to use it on a more basis where the costs, we expect that the costs are discretionary and zero-based can be put to advantage. We are now going to talk about transfer pricing. Transfer pricing is a financial means for evaluating divisional performance. Established transfer price is a cost to the receiving division and revenue to the supplying division. Transfer price will affect profitability of both divisions. We are now going to move from the topic of budgeting and discuss transfer pricing. Transfer pricing is something that will occur in an organization, perhaps where there are two different divisions. One product could be produced in one division, and then it is transferred to another division where it is completed and the final product is made and then sold into the market. So transfer price will be the price at which one division will, if you like, sell its product to another division. It's all happening within the organization, within the same company. One division is making a part of the product, a component, and it is then selling it to another division which is using this component in the final product and selling it outside. Normally this would apply to larger type of companies where a fairly detailed and complete process is made in one division and the entirely new different process is completed in another division. But it can happen in many different organizations in a different way. For example, organizations might want to charge for the services which are being consumed by various departments. So one of the services is maintenance. So if organizations want to charge the departments for maintenance, then they will have to set a price in accordance with preset rates for all the work that they do for any one production department. If a machine comes in for repairing, the repair and maintenance department is going to fix and then allocate a cost to it based on their cost of workers, hourly rates, overheads, and things of that nature. So this can be regarded as a pricing of a service within the organization. This can sometimes even include a profit element where the organization wants to work in that way. But it can also be on the basis of cost. So it can be a smaller organization or a larger organization where one part is being prepared in one area and another in another area and completed and sold later on. There is a price element, and the transfer price is a price which is used for transferring the product from one division to another. This is a significant thing, and very often it will play an important role in determining overall profitability, the quality of decisions that are made within the organization, and also the performance of the various divisions. Sometimes where companies have an international presence, multinational companies, then a different international perspective can be taken on transfer price, and transfer price can be used as a mechanism of allocating the profits to different areas and locations. How will that happen? The transfer price is going to have an effect on the revenues of the supplying division. So where the price is set higher in the supplying division, that division is likely to have a certain amount of profit, and this is going to be, for the next division, the buying division, it is going to be cost. So the cost is going to be higher in the receiving division, and therefore the profits in the receiving division will be less, whereas the profits in the supplying division will be higher, where the transfer price is set at a high level. We'll examine these things, and we will examine some examples to clearly understand how the principles of transfer pricing work and what are the different methods that can be adopted for transfer pricing. Transfer pricing can also apply to cost centers, i.e. support service centers sometimes there is no need for a profit element to be included. So we have said that this transfer price can be at a level where there is some profit, and it can also be at a level when there is no profit. We will see the benefits and the advantages and disadvantages of both, of having a profit within the cost center or division and of not having, and how this impacts the overall operation of the full organization. Purpose of transfer pricing: to provide information that motivates divisional managers to make good economic decisions, provide useful information for evaluating managerial performance and economic performance of divisions and cost centers, to intentionally move profits between divisions or locations, and to encourage divisional autonomy. So now we come to the purpose of transfer pricing. We have said that essentially a transfer pricing mechanism can be used to motivate managers into making good economic decisions. One has to be careful in this way at this time to differentiate between the benefits and the economic decisions for a division and for the economic decision of the company as a whole. And we will see later on that many times there can be a conflict between what the division regards for itself as a motivating and a good economic decision, and whereas when we look at the organization as a whole, the decision might not be appropriate. So transfer pricing can be used as a mechanism for ensuring a good overall economic decision. Secondly, we have said that it provides information for evaluating managerial performance. We are going to look at the performance of different divisions, see how profitable one division has been compared to another, the efficiencies and the profitability, etc. This information is again in a way influenced by the transfer pricing, because transfer pricing is going to determine the revenues for this supplying division. And the revenues and the extent of the revenues might determine the profitability of that division, which might have an impact on the performance evaluation. Then on the international scenario, there might be a need to locate profits in certain regions. Organizations might find it beneficial to have profits in regions where taxation rates are low, and to try to divert profits and have lower profits where the taxation rates are high. So location of profits can be influenced by transfer pricing. It can be used as a mechanism to locate the profits. And lastly, as a purpose, we said that it promotes divisional autonomy. By divisional autonomy, we mean that the division should regard itself as a separate entity and be responsible for all the decisions that it makes, and try to be accountable for the performance of that division. So divisional autonomy is an important aspect where managers, if they have the feeling that they are going to be accountable for the decisions they make, and at the same time be credited or rewarded for their decisions, that is a greater motivational factor. So transfer pricing can be used as a way in which divisional autonomy is encouraged. Information for good economic decisions. Goods transferred from one division to another are known as intermediate products, whereas those sold to outside world are known as final products. Transfer prices are used to determine the values of intermediate products. It can also be used for decisions on whether the product should be sold or processed further. This is done on incremental cost basis. Intermediate products are those products which have been prepared and produced in one division to supply to another division. That's an intermediate product. Where the division is then producing and using this intermediate product and completing it and selling it outside, that is then the final product. So division to division is the intermediate product, and when it is being sold outside the organization, then it is the final product. So transfer pricing is something that is used for pricing of the intermediate product, transferring and pricing the product from one division to another. Let's think of some example. Let's say in a shoe manufacturing industry, you might have one division that is producing just the sole. Just the sole of the shoe is produced in one division. And that sole is then sold to another division. And another division will buy the soles and complete the shoe and sell to the market. So in this case, the sole is the intermediate product, and the complete shoe is the final product. And the transfer price will be the price used for transferring the sole from one division to the next. In this case, the sole producing division is going to set the transfer price, and this price will be the revenue for the producing unit, and it will be a cost for the receiving unit. And the receiving unit will then complete and sell the final product outside. So this is the use of the transfer pricing mechanism. We would think that normally these are large companies that need this kind of an operation and this kind of a transfer pricing mechanism. It may be so, but as we have said, that smaller companies can use this mechanism to price their services. It can also be used for decisions on whether the product should be sold or processed further. This is done on incremental cost basis. So another usefulness of this transfer price is whether the product should be produced or whether it should be purchased from the market. Several different factors will need to be taken into account in arriving at a decision like this. And one decision is going to be the excess capacity of the organization. The division that is producing the intermediate product, if that has spare capacity and therefore it is not able to sell the entire amount of products that it can produce, then it would be advantageous and have a different perspective for the whole company if the other division would buy from outside and not from its own division. So these are the factors that are going to be involved in whether it should be further processed and then the fact that whether it should be sold outside the market. So where there is a market for the intermediate product, there it will have the option of selling the intermediate product to the outside market, and the division might have the option for buying from outside. So these kind of decisions, the pricing is going to be an important aspect. What price to use to make a decision of this nature, whether it should be produced and whether it should not be purchased from outside. These decisions we have discussed before in the relevant cost and incremental cost basis kind of decisions. So the decisions are going to be based on incremental cost basis to look at the overall benefit for the organization. Managers must take into account and take care not to treat transfer price as incremental cost. For the receiving division and for the receiving manager, if he takes the transfer price to be the incremental cost of producing the unit and the final product, that might not be appropriate. He might then use the pricing and the cost structure which perhaps is not the real cost to the entire company. Where, for example, the supplying division is adding a markup for profit. and it is selling at a price which is higher than its own incremental cost, then that price is not the incremental cost for the entire company, even though it might be considered as incremental cost for the final product division. So care has to be taken, and managers need to be aware that the overall company perspective should be borne in mind, and cost must be allocated and looked at in a way so that the overall company perspective is kept and production and decisions are made on a company-wide basis. For example, assume the incremental cost of an intermediate product is rupees 100 and additional cost of further processing is rupees 60. The incremental cost of the final product will therefore be 160 rupees. Also, assume there is a temporary excess capacity and that the market price of the final product is 200. The correct decision would be to convert intermediate product into final product. So we are going to look at this example where intermediate product, the incremental cost is 100 and the incremental cost of the final product is 60. Overall incremental cost of the organization is 160 rupees, where the selling price and the market price is rupees 200. The managers will consider that this is beneficial and we are going to produce and buy at this level and sell to the market. The transfer pricing is set at 100, which is the incremental cost, and therefore the incremental cost of 100, that's the transfer price. Add to that the incremental cost of the final product division of 60. 160 is the cost, and they will sell at the price of 200. If the transfer price was based on full cost plus profit margin and set at rupees 150, the incremental cost of the final product would be rupees 210, 150 plus the 60. The manager would decide not to purchase the intermediate product for further processing as the incremental cost is more than the selling price. This would be an incorrect decision. Now in this example, if we are going to assume that there is a markup on the cost being transferred. So the transfer price is, the incremental cost is 100, and let's say there is a markup to cover profits and other expenses, and the product, intermediate product, is transferred at a price of 150. The receiving manager is going to take 150 as his cost and add to that his own incremental cost of 60, and he will say that his total cost is 210. So he will not be prepared to buy this component at 150 and sell at a price of 200 because the incremental cost on his division basis alone is 210. Clearly, this would be an incorrect decision for the company because the company incremental cost is 160. But because of the transfer price mechanism, the cost can be regarded as 210, and therefore the production manager will refuse to produce and sell at 200, thinking that this will be a loss-making exercise. So that's how the perspective of the entire company needs to be carefully borne in mind when using transfer prices, and especially to look at the profitability on a company-wide basis. The correct decision would be to convert intermediate product to final product. If the transfer price was based on full cost plus profit margin and set at 150, the incremental cost would be 210. In this case, the manager would decide not to purchase. The problem would be overcome if transfer price is set at the incremental cost of rupees 100 in this example. So this problem, where the manager might misunderstand the total cost and might make a decision not in the interest of the company, would be overcome if the incremental cost in the first place in division producing the intermediate product is used. In our example, This was rupees 100. So 100 is the incremental cost, and that is used as a transfer price for division 2, and that is going to have the cost of 160, and therefore the appropriate and correct decision will be made for the organization as a whole. Evaluating divisional performance. The price at which goods are transferred from one division to another will influence the division's reported profits. An unsound transfer price will result in a misleading performance measure. The divisional manager may feel transfer price is affecting his performance unfairly. This may have a negative motivational consequence. Another purpose of transfer pricing, we said, was to evaluate divisional performance. In evaluating divisional performance, the role played by transfer price is to determine profitability of the producing unit, of the intermediate product. So when this transfer price is set at a level where it does not allow for the entire fixed cost of the producing division to be covered, and that will happen when it is based on the incremental cost. If it's based on incremental cost, it will happen that the fixed cost of the producing division will be not covered under this price. And so that division might show a loss, a reported loss. And the divisional performance and the manager, if he is going to be assessed on the division's performance on this basis, he might feel that this has affected him unfairly. The price has been set at an incremental basis, and my fixed costs have not been covered. I have not been able to charge the market price, and I am being held accountable for the lack of profits or the losses. So this will have a negative motivational impact, and therefore it is going to be an important consideration for organizations to set transfer prices in a way that when you are evaluating divisional performance, then you look at the performance in this perspective, and you give the division the performance and the credit for what they have actually accomplished. Conflict of objectives. No single transfer price will perfectly serve all four specified purposes. They often conflict, and managers are forced to make trade-offs. The decision-making and performance evaluation may conflict with each other. For example, sometimes in the short term, the transfer price for optimal economic decision is the marginal cost. Very often, this will equal variable cost. The supplying division will fail to recover its fixed overheads and may report a loss. Further, as shown, transfer price satisfactory for divisional performance leads to incorrect decisions from a company-wide perspective. So this is the kind of conflict that might arise in the objectives of the transfer pricing. Using one single transfer price to assess both the divisional performance as well as the economic decisions for the company, these two decisions, as we have seen, they might conflict. Whereas from an overall organization perspective, the marginal cost or the incremental cost basis should be used as transfer pricing, but that might lead to a situation where the producing and supplying division shows a reported loss. Hence, there is a conflict which needs to be managed in the organization, and management will need to take into account factors such as these when they are using transfer price for both the purposes. That's all for today. Thank you very much.